Every empire has its breaking point. For some, it's war. For others, it's corruption, overreach, or decay. But for the United States, the threat may come not from outside, but from within. A quiet, invisible force that grows stronger every day. It's not an enemy or an ideology, it's math. The United States is now more than $35 trillion in debt. That number is so large, it barely feels real. But the consequences are very real. Because that debt isn't just a number on a screen, it's a promise. A promise that one day, someone will have to pay. And as the decades pass, that promise has started to look less certain. The U.S. debt crisis isn't a sudden event waiting to happen. It's a slow motion storm that's been building for generations. A story of ambition, politics, and the illusion that debt can rise forever without consequence. To understand it, we have to go back to where it all began, when America first learned that borrowing could build power. In the years following World War II, the United States stood alone as the world's economic superpower. Europe and Asia were rebuilding, their factories in ruins, their currencies weak. America, by contrast, was booming. The dollar became the backbone of global finance. Under the Bretton Woods system, the world's major currencies were tied to the dollar, and the dollar itself was tied to gold that made U.S. debt the safest investment in the world. At the time, government borrowing was seen as a tool for progress, something used to fund recovery, infrastructure, and innovation. And for a while, it worked beautifully. But as the 20th century unfolded, something changed. Debt wasn't just a response to crisis anymore, it became a way of life. In the 1960s, President Lyndon B. Johnson launched the Great Society, massive new programs aimed at fighting poverty and expanding social welfare. At the same time, the U.S. was fighting an expensive war in Vietnam. The government tried to fund both without raising taxes. The result? Rising deficits. By the early 1970s, foreign nations holding U.S. dollars began to worry that America didn't have enough gold to back its currency. In 1971, President Richard Nixon made a decision that would reshape global finance forever. He ended the dollar's convertibility to gold. From that moment on, the dollar was backed not by metal, but by trust. Trust in the U.S. government's ability to manage its finances and honor its debts. That trust has carried the world economy for over 50 years. But it also created a new reality. Without the gold standard, there was no longer any limit to how much money the U.S. government could create, or how much debt it could take on. In the decades that followed, each generation added another layer to the debt. In the 1980s, Ronald Reagan cut taxes and increased military spending, tripling the national debt in less than a decade. In the 1990s, Bill Clinton briefly reversed the trend, producing a budget surplus for the first time in decades. But that window of fiscal restraint didn't last long. After the attacks of September 11th, 2001, the United States entered a new era of war and security spending. The wars in Afghanistan and Iraq added trillions. Then came the 2008 financial crisis, the largest economic collapse since the Great Depression. To save the system, the government borrowed and spent at historic levels. The Federal Reserve slashed interest rates to zero and began buying government bonds, effectively creating new money to fund the debt. It worked, at least in the short term. The markets recovered, the economy stabilized, but the debt never went away. It grew, faster than ever. By 2010, the U.S. owed over $13 trillion. A decade later, that number had more than doubled. And when the COVID-19 pandemic struck in 2020, Washington opened the floodgates. Trillions were spent on stimulus checks, unemployment benefits, and business loans. In a single year, the U.S. added more debt than it had in its entire first century of existence. And once again, The Federal Reserve stepped in to make it all possible. Through a process called quantitative easing, it created money digitally to buy trillions in U.S. bonds. That kept interest rates low and made borrowing even easier. But easy money comes with a cost. It distorts markets, inflates asset prices, and encourages the illusion that debt doesn't matter. For years, politicians on both sides leaned on that illusion. Debt became a political weapon, one used to fund promises, win elections, and avoid hard choices. Because in Washington, cutting spending is unpopular. Raising taxes is even worse. Borrowing, though. Borrowing feels painless until it isn't. Today, America's debt is growing by roughly $1 trillion every 100 days. That's more than $10 billion every 24 hours. And that pace is accelerating. Economists call this the debt snowball effect. When borrowing becomes routine and interest payments start to consume a larger share of the budget, the debt feeds on itself. In 2024, the U.S. spent over $1 trillion just on interest, more than it spent on national defense. Within a few years, interest payments will exceed the cost of Medicare, then Social Security. It's an inflection point, where the cost of past borrowing begins to choke future spending. The government faces an impossible choice: borrow even more, cut vital programs, or raise taxes dramatically. None of those options are politically sustainable, so the debt keeps rising. What makes this crisis especially complex is that the system still appears to work. Markets remain stable. Treasury bonds still sell. The dollar still dominates global trade, but that stability hides a dangerous truth. It depends entirely on confidence. Confidence that the U.S. will always pay its bills. Confidence that inflation will remain under control. Confidence that the dollar will always hold its value. That confidence is what separates the United States from the countless nations that have collapsed under their own debt. But confidence isn't permanent. It's earned, and its fragile foreign governments hold more than $7 trillion in U.S. debt. They do it not because they have to, but because there's no alternative. U.S. Treasuries are still considered the safest asset in the world, the benchmark for global stability. But cracks are beginning to show. China has been quietly reducing its holdings. Japan, the largest foreign creditor, is under pressure to repatriate funds to support its own economy. And central banks across Asia and the Middle East are buying more gold than ever before. Each of these moves sends the same message. The world is hedging against the possibility that the U.S. may no longer be the unwavering pillar it once was. At the heart of the issue is a simple question: how much debt is too much? Economists have debated this for decades. Some argue that as long as the economy grows faster than the debt, it's sustainable. Others warn that when debt passes a certain threshold, around 100% of GDP, it starts to slow growth, distort investment, and undermine confidence. The United States crossed that line years ago. Today, its debt sits at over 120% of GDP. And because so much of it needs to be refinanced every few years, even a small rise in interest rates can dramatically increase costs. That's what happened in 2022 and 2023, when the Federal Reserve raised rates to fight inflation. For the first time in decades, the cost of servicing the debt exploded. What had once been manageable suddenly looked unsustainable. The math is simple and terrifying. If interest rates stay at current levels, America will add another $20 trillion in debt over the next decade just to cover deficits and interest payments. That means by 2035, the U.S. could owe more than $55 trillion. That's not a forecast. That's the government's own projection. And yet, despite these warnings, the political system remains paralyzed. Every discussion of fiscal reform ends the same way, with promises, arguments, and no action. Because in Washington, debt is no one's problem and everyone's convenience. But debt doesn't care about politics. It grows quietly, invisibly, until one day it doesn't. Every major debt crisis in history has followed the same pattern. First comes denial, the belief that this time is different. Then comes rationalization. We can always print more money. And finally comes the reckoning, when confidence breaks and the system begins to unravel. The US hasn't reached that point yet, but the conditions are forming. Rising deficits, political gridlock, aging demographics, and an economy increasingly reliant on low interest rates. All the classic ingredients are there. And while no one knows when the breaking point will come, history suggests it's never as far away as people think. The modern U.S. economy runs on debt. Not just government debt, but household, corporate, and financial debt too. Debt has become the oxygen of the system. It fuels growth, consumption, and even innovation. Every major institution, from Wall Street to Washington, depends on the continuous creation and recycling of debt. Without it, the machine stalls. This is the paradox of modern finance. The system needs debt to function, but too much of it threatens to destroy that very system. When the U.S. government borrows, it issues treasury bonds. Those bonds are bought by investors, banks, pension funds, and foreign governments. In return, the U.S. promises to pay interest and repay the principal in the future. That future, however, never truly arrives. Because when old debt matures, it's paid off by issuing new debt. This process, refinancing, is how the U.S. has rolled over its obligations for decades. In practice, it means the country never actually pays off its debt. It just keeps borrowing to cover what's due. And because the global economy trusts the dollar, investors keep lending. It's a system built on confidence, a delicate balance of faith and necessity. The Federal Reserve, America's central bank, plays a critical role in this cycle. When the government issues bonds, the Fed can buy them, creating money in the process. This injects liquidity into the economy, lowers interest rates, and makes borrowing easier. For years, this approach seemed harmless, even beneficial. Inflation remained low, and markets kept rising. But behind that apparent stability, the foundation was shifting. The economy became addicted to cheap money. Every slowdown was met with more stimulus. Every crisis required more intervention, and each intervention made the next one larger. By 2020, the U.S. was spending over $6 trillion per year, while collecting barely $4 trillion in revenue. The gap was filled by debt, and that debt was enabled by the Federal Reserve's willingness to print money and suppress interest rates. For decades, this partnership between fiscal policy and monetary policy worked until inflation returned. In 2021 and 2022, consumer prices began to surge. What had been dismissed as temporary, inflation turned into a structural problem. The Federal Reserve had no choice but to raise interest rates. But higher rates changed everything. Suddenly, new debt became more expensive. Old debt had to be refinanced at higher costs, and the government's interest bill began to soar. The U.S. Treasury found itself in an impossible position. It needed to issue more bonds to cover spending, but each bond cost more to maintain. That's how debt spirals begin, and once they start, they're almost impossible to reverse. Still, the system hasn't collapsed. Not yet, because the world still needs U.S. debt. Treasury bonds are more than just a financial instrument. They're the bedrock of global finance. Every central bank holds them as reserves. Every pension fund uses them for stability. Every major corporation prices its risk against treasury yields. If treasuries disappeared, the global financial system would lose its anchor. That's why, even as U.S. debt grows, demand remains strong. Investors might worry about the numbers, but they still see treasuries as the safest bet in a risky world. This is what economists call the exorbitant privilege of the dollar. It allows the United States to borrow in its own currency at interest rates lower than almost any other nation. It means America can finance wars, stimulus packages, and bailouts without facing the same consequences other countries would. In essence, the rest of the world funds America's deficits, because doing so sustains the system they all rely on. But that privilege is not guaranteed forever. It depends on a delicate balance. Trust in the dollar, trust in U.S. institutions, and trust in political stability. If any of those pillars weaken, the dollar's dominance could begin to erode. Not overnight, but gradually, as more countries seek alternatives. We're already seeing early signs of this shift. Nations are exploring trade in local currencies. China and Russia are building alternative payment systems. India and Brazil have discussed settling oil trades without using dollars. Even traditional allies are diversifying their reserves. Gold purchases by central banks have surged to record highs. It's a quiet but unmistakable signal. The world is preparing for a time when U.S. debt may no longer be the unshakable foundation it once was. If the world ever moves away from the dollar, the consequences would be profound. The U.S. would lose its ability to borrow cheaply. Interest rates would rise, inflation could accelerate. And the government would have to make hard choices: cut spending or print more money. Printing, of course, is the politically easy option. But it comes with a hidden cost: the erosion of purchasing power and the quiet destruction of savings. Inflation is, in many ways, a stealth tax, one that punishes the poor and middle class most. It's how nations in debt crises often cope, by devaluing their currency rather than defaulting outright. The U.S. wouldn't call it default, but for anyone holding dollars, it would feel the same. The irony is that much of this was predictable. Economists have warned for decades that unchecked borrowing would eventually collide with rising costs. But warnings don't win elections. Promises do. In Washington, the incentives are simple. Short-term gains outweigh long-term responsibility. Leaders borrow now and let the next generation deal with the consequences. And, because the U.S. has the global reserve currency, it's been able to delay those consequences longer than anyone else. But no system, no matter how privileged, can defy arithmetic forever. Behind every trillion in new debt lies a deeper imbalance. Social Security, Medicare, defense, and interest payments now consume nearly all federal revenue. Everything else, infrastructure, education, science, even disaster relief, must be funded through additional borrowing. That's not a sustainable model. It's a signal of a government trapped by its own obligations. Even small shocks, a recession, a market crash, a geopolitical crisis, could tip the system into instability. Because when debt levels are this high, the margin for error disappears. The danger isn't that America will suddenly default. It's that the world will slowly lose faith in its ability to manage the debt responsibly. Confidence, once lost, doesn't return easily. And without it, the U.S. would face a new kind of crisis, one not of liquidity, but of credibility. In that kind of crisis, investors demand higher yields. Higher yields increase interest costs. Higher costs create more deficits. It becomes a loop, the same loop that pushed smaller economies like Greece, Argentina, and the UK in 1976 to the edge. But this time, it's happening at a global scale. What makes the situation more fragile is timing. Much of America's existing debt matures in the next few years. That means trillions must be refinanced at today's higher rates. Each auction brings a question. Will investors keep lending at low yields? Or will they start demanding more compensation for the growing risk? If demand weakens, the Treasury must raise rates further to attract buyers. That raises costs, which worsens deficits, and the cycle accelerates. This is how confidence erodes, not in a crash, but in a gradual repricing of risk. For now, the Federal Reserve remains the ultimate backstop. If markets falter, it can step in again, creating money to buy bonds and stabilize yields. But that solution has limits. Every time the Fed expands its balance sheet, it signals to the world that U.S. debt is not being managed, it's being monetized, and that carries its own danger: inflation, currency debasement, and global distrust. It's a path that looks stable until the moment it isn't. The truth is, America's debt problem isn't purely financial, it's psychological. For decades, the public has been told that deficits don't matter, that debt is manageable, that the government can always pay. And for decades, that seemed true. But confidence is a fragile construct. It can survive decades of abuse until the moment it doesn't. When that moment comes, it's not numbers that change first, it's perception. The sense that something once unthinkable might actually happen. That shift, once it begins, is nearly impossible to stop. The question isn't whether America will face a reckoning, it's when. The current system is sustainable only as long as growth outpaces debt. But growth is slowing, productivity is stagnating, and political consensus is disappearing. At some point, investors will demand proof, not words, that the U.S. can stabilize its finances. If that proof doesn't come, confidence will start to fray. And when confidence frays, markets move faster than politics can react. The breaking point never announces itself. There's no siren, no headline that says the system has failed. It begins quietly, as a loss of faith. One auction goes poorly. A few foreign buyers step back. Bond yields rise faster than expected. Suddenly, the Treasury's financing costs spike, and the pressure begins to mount. Investors start asking questions. How much longer can this last? What happens if rates stay high? And, most dangerously, what if the U.S. can't roll over its debt anymore? These questions, once confined to academic circles, begin echoing across trading floors, media outlets, and public debates. Confidence, the silent cornerstone of the entire system, starts to tremble. When a nation's debt exceeds its capacity to pay without printing, history offers only a few possible outcomes. Some default, some devalue, and some inflate their way out, quietly eroding the value of what they owe. For a country like the United States, default is politically unthinkable, so inflation becomes the path of least resistance. But inflation is not just an economic event, it's a social one. When prices rise faster than wages, the middle class feels squeezed. Savings lose value. Housing, healthcare, and education, already expensive, become unreachable for many. The promise of upward mobility starts to fade, and when faith in money erodes, so does faith in institutions. We've seen this before, in different forms. In the 1970s, inflation surged, the dollar weakened, and global confidence wavered. It took a painful intervention, Paul Volcker's aggressive rate hikes, to restore credibility. But that era's debt levels were far lower than today's. Back then, the federal debt was around 30% of GDP. Today, it's over 120% and climbing. That means the same cure, raising rates high enough to crush inflation, could now trigger a fiscal implosion. Every percentage point increase in rates adds hundreds of billions to annual interest costs. In other words, the very medicine needed to save the dollar could destroy the budget. This is the trap of debt. The more you owe, the fewer choices you have. At some point, a government with no easy options begins to improvise. First come the accounting tricks: extending maturities, shifting funds, extraordinary measures. Then come the new taxes, framed as temporary or targeted. Then perhaps capital controls, or wealth taxes, or inflation that's tolerated as the cost of recovery. Each measure buys time, but time, in a system built on debt, comes at an ever increasing price. As the debt burden grows, markets evolve into a kind of surveillance system. Every movement in Treasury yields, every shift in the dollar index, becomes a referendum on America's credibility. A few years earlier, these fluctuations would barely register. Now, they dominate headlines. The debt has become the economy. Stock markets no longer rise on innovation or earnings, but on the hope of lower rates and new stimulus. Growth becomes financialized, dependent not on productivity, but on liquidity. And the line between economic policy and market management disappears. In that environment, the Federal Reserve becomes both savior and suspect. When the Fed cuts rates, it's accused of fueling bubbles. When it raises them, it's blamed for hurting the economy. Trapped between inflation and instability, it walks a narrow line, knowing that one misstep could trigger panic. The central bank's credibility, once unquestioned, begins to fracture. People start asking, who really controls the economy? And more dangerously, who does the system serve? The answer, increasingly, seems clear. Those closest to the flow of money: banks, asset managers, and the politically connected. To ordinary citizens, the debt feels like someone else's spending, but everyone's problem. As interest costs devour the budget, the government faces an impossible arithmetic. In one column, Social Security, Medicare, defense, infrastructure, and public salaries. In the other, interest payments, rising faster than any of the above. At some point, the two collide. That's when the conversation shifts from how much can we borrow to what must we cut. But in a democracy, every cut has a constituency, every reform has an opponent. And so, gridlock becomes policy. Deficits grow not because of greed or malice, but because paralysis becomes the only politically viable choice. Behind the scenes, global power dynamics begin to shift. China continues to reduce its holdings of U.S. treasuries. Oil exporters experiment with pricing energy in multiple currencies. Emerging markets, once eager buyers of American debt, begin building their own regional financial systems. The dollar remains dominant, but the cracks are visible. It's still the world's main reserve, but now, for the first time in generations, it has competitors. Gold, digital assets, and even commodity-backed trade arrangements start to nibble at its edges. It doesn't happen overnight, but it doesn't have to. All it takes is a few percentage points of global reserves shifting away from the dollar to make U.S. borrowing costs rise sharply. And once borrowing costs rise, the spiral tightens further. At home, the social fabric begins to reflect the financial strain. You can feel it in the polarization, the distrust, the anger directed at unseen systems. People sense that something is fundamentally out of balance, that the economy grows, but their lives don't. That productivity rises, but their security doesn't. The debt is no longer just a line on a government balance sheet. It's a mirror reflecting the nation's priorities. It shows decades of consumption over production, speculation over savings, politics over principle. And yet, despite everything, the system continues. For one simple reason: there is no alternative big enough to replace it. The end of a financial order doesn't look like a crash at first. It looks like fatigue. Like the gradual acceptance that yesterday's rules no longer work. The markets adjust quietly. Investors hedge in new directions. Governments make small, symbolic reforms that do little to change the underlying trend. Then, one day, a tipping point arrives. A failed bond auction, a political standoff, a global event that tests the system's resolve. The moment confidence finally snaps, the shift is immediate. Yields surge. The dollar slides. And what once seemed unthinkable, that the world could lose faith in U.S. debt, becomes reality. When that day comes, the consequences unfold in waves. The first is financial: higher interest rates, falling markets, tightening credit. The second is political: emergency measures, spending freezes, rhetoric about shared sacrifice. The third is social: protests, unrest, and the loss of faith in the idea that hard work guarantees stability. But the fourth wave, the most transformative, is philosophical. It forces a nation to confront a question it has avoided for generations. What is money, really? If dollars can be created without limit, but their value depends on trust, then money is not a thing. It's a belief. And once belief fades, no amount of policy can restore it overnight. In the aftermath, reform becomes inevitable. A new monetary framework emerges, maybe digital, maybe global, maybe tied to commodities or fiscal rules. The world doesn't end. It evolves. But the transition is messy. Fortunes are lost. Institutions crumble. Old powers fade while new ones rise. It's the natural cycle of empires and economies. The pattern has repeated through history, from Rome to Britain, from the guilder to the pound, and now the dollar stands at that same crossroads. Still, within every crisis lies an opportunity, the chance to rebuild on sounder principles. The U.S. remains rich in innovation, resources, and talent. It still commands the world's deepest capital markets and most dynamic companies. But the key to renewal isn't financial engineering, it's discipline. Discipline to spend wisely, to invest in productivity rather than speculation, to value savings as much as consumption, to restore trust, not through slogans, but through results. If that lesson is learned, the next century could still belong to America, not by printing power, but by earning it. In the end, the U.S. debt crisis is more than an economic story. It's a test of civilization's maturity, a measure of whether a society can confront its excesses before they consume it. Because every empire ends the same way, not in conquest, but in debt. Debt that erodes the will to reform. Debt that demands ever more sacrifices for ever smaller returns. Debt that turns prosperity into dependence. But history also shows that renewal is possible, if truth is faced early enough. The question is whether America will face it by choice or by necessity.